Welcome, everyone, to Johnson & Lambert's annual Statutory Accounting and Tax Update. I'm Bobby Wazak, Senior Manager with Johnson & Lambert, and before I introduce your speakers in a moment, I'd like to cover a few administrative items with you. You can download a copy of today's presentation from the Resources window at the bottom of your screen. If you do experience any technical difficulties during the webcast, please click on the Help icon. To engage with our great presenters, please submit your questions through the Q&A icon. We will do our best to answer as many of your questions during or at the end of the session. For those interested in receiving CPE or CRE credits for participating in today's webinar, I'd like to call your attention to the certificate icon. You can launch the certificate window to monitor your progress toward earning your certificate. Once you meet your criteria, you will see the certificate image appear in the certificate window. Click on the image to download your certificate. The only way to obtain your CPE, CRE certificate is by downloading it through this platform. Credit is not available for group viewing. Johnson & Lambert uses polling questions for credit verification purposes. To receive your CPE, CRE credit for today's session, you will need to be present for at least 50 minutes and answer at a minimum 3 polling questions. We have assembled a terrific panel for today's session. We have Lauren Darr, partner with the firm. Lauren has attended all the NAIC meetings and is on the NAIC and AICPA group task force. Good afternoon, Lauren.
Good afternoon, everyone.
Lauren will be joined by Rachel Ferguson. Rachel is a principal with the firm. Nice to have you with us, Rachel.
Great to be here. Thanks.
And to discuss certain tax matters, please welcome one of our tax partners with the firm, Brandy Vanoy. Good afternoon, Brandy.
Good afternoon.
So today our broadcast will cover a multitude of items, including tax matters that will impact your 2020 statutory financial statements, limited time interpretations with respect to COVID-19, and we will also touch on new and amended statutory accounting requirements. We will then close our session with a discussion on auditing standard updates, and Lauren will highlight those key updates for us. We have a fully packed session today, so let's begin with some tax matters that will impact your financial reporting. As you may know, there has been a lot of activity this year with respect to tax matters related to the Paycheck Protection Program, the CARES Act, and most recently, the Consolidated Appropriations Act 2021. Brandy, can you walk us through the deductibility provisions and deferral of payroll taxes with respect to these new acts?
Absolutely. Thanks, Bobby. As Bobby mentioned, there is not a shortage of tax laws and tax guidance that's been coming out this year. So we could talk for 2+ hours about all the tax changes that have happened from 2017's Tax Cuts and Jobs Act through the Consolidated Appropriations Act that was just issued. But today, we're really going to stay focused on mainly the CARES Act and the implications related to tax that came out of the CARES Act that would impact your statutory financial statements. So with that, we are going to start with the PPP loans or payroll protection loans. I don't think these really require much explanation. Most of you guys know what that means. Many of you probably applied and are in the process of applying for forgiveness for these. As such, when the payroll protection loans were created as part of the CARES Act, Congress specifically said any income forgiven related to these loans would not be includable in your income. However, that's where they left it. So the IRS picked up from there and said, that's fine. We won't include the income as we normally would for forgiveness of debt. But instead, we're not going to let you double dip. And we're not going to let you not pay tax on that income, but then continue to deduct expenses that you're paying for with these loans. So the IRS stood really strong to that decision and issued some rev procs later in the 2020, explaining exactly how those expenses would be disallowed and the timing of how that would all happen. Shortly following that became what is now known as the Consolidated Appropriations Act of 2021, in which Congress said that was never our intent to have any sort of tax implications to this forgiveness of loans. So we're going to make sure it's very clear and say the income should not be taxed and all of the expenses should be allowed. So all of the work the IRS did and explaining how these expenses would not be disallowed is a moot point. End of the story is if you do have PPP loans and they are forgiven, there is no tax implications. So basically you would not have forgiveness of debt income, and you would be able to deduct expenses related to those. Any expenses you incurred in your normal course of business that was basically coming from that loan, which is really good news to all taxpayers. The next piece that came out of the CARES Act that could have an implication to your financial statements is the payroll tax deferral. There was two payroll tax deferrals that happened during 2020, one being the employer side of Social Security taxes, which is part of the CARES Act and what we're going to discuss today. The other payroll tax deferral was focused on employees' portion of payroll taxes, and that's not the portion we're going to talk about. So in regards to what the CARES Act said, they said that employers could defer the amount of Social Security taxes that were due in 2020 from March through December 31st of 2020. And those taxes would not be payable until the end of 50% at the end of 2021 and the other 50% at the end of 2022. Again, great news, help for a lot of these taxpayers. But when you have to start thinking about things from a tax side of things, it changes a little bit in that companies are likely still accruing for these payroll taxes, since they know that they will have to pay them in the next 2 years. However, for tax purposes, you're not allowed to take a deduction unless those taxes are actually paid. So we have been discussing this with clients and asking them, and we'll be asking as of year end, how much of those payroll taxes that they've expensed have not actually been paid, and we would not be allowing that a deduction until it's actually paid. The next piece of guidance that came out with the CARES Act, which I know for us had a big implications, was the change in the NOL rules. Again, going back to 2017 and what changed with the Tax Cuts and Jobs Act was NOLs, net operating losses, were no longer eligible to be carried back for every entity except for property and casualty insurance companies. All other entities were no longer allowed to carry back NOLs. However, they could carry them forward indefinitely, but limited to 80% of their income. The CARES Act, as a stimulus bill, really was trying to get money back into the hands of all of the taxpayers as quickly as possible. So one of the things that they did was allow NOLs to be carried back again. They did extend the carryback period, so any loss, taxable loss that was created in 2018 tax year, 2019, or 2020, those losses would be eligible for a 5-year carryback. This is really important since the tax rate was higher in all tax years prior to 2018. So by giving these companies carrybacks, you not only got a carryback when you wouldn't have otherwise, but you're also getting a refund at a higher tax rate. So this was something that was a huge benefit to anyone who had those losses. What you should be thinking about from a statutory reporting perspective, if you were one of these taxpayers that took advantage of the NOLs, would be admissibility. So as you're going through your admissibility calculation and following SAP 101, the first part of the admissibility is, would you be able to realize the benefit of any of your deferred tax assets through a carryback? And like I mentioned, the Tax Cuts and Jobs Act had said no carrybacks except for property and casualty companies. Well, now you do have companies, life insurance and all others. Well, life insurance, I guess, would be the only one that statutory would be applicable for. But because of the way that the calculation is working for 2020, you still aren't eligible, because you'd be looking at 2021 reversing items, so you still aren't eligible for that very first step of the carryback period and for the admissibility under SAP 101. So life companies still would not, in the 2020 financials, would not get to admit anything under 11A of SAP 101. However, if you were previously had a valuation allowance set up due to losses that were incurred in 2018 and due to the new rules, you weren't eligible to be carried back and didn't foresee how they would be utilized in the near future and therefore set up a valuation allowance. Now, due to the change in the NOL rules and being able to carry back those 2018 losses, you would likely no longer need a valuation allowance. So this is, again, a very good thing on your financial statements. You would no longer have a deferred tax asset. You get to recognize a current benefit and no longer have any valuation allowance considerations. So just sort of a thought as you're going into filing for annual statements and calculating tax provisions, make sure you're thinking through these tax law changes for NOLs and looking at your admissibility and your valuation allowance discussions. Also, with the NOLs, like I mentioned, the tax rate's different in those years prior to 2018. So if you did take advantage of these carrybacks, you would now be recognizing a current benefit. You would likely not have reported that current benefit in 2018 or 2019's financials. So now you would need to basically true that up and recognize a current benefit for any carryback that you have applied for, and make sure that you're recognizing that benefit at the rate you actually get a refund. So hopefully a higher rate versus the 21%. Moving on, another benefit that the CARES Act provided was for qualified improvement property. In the Tax Cuts and Jobs Act, they did away with what was previously known as leasehold improvements. And they grouped it into another category called qualified improvement property. No big deal, that's all fine. However, they failed to note that this property had a lesser tax life. Historically, leasehold improvement property had 15-year life. Qualified improvement property was intended to have the same life, but it was just an error in the drafting of the Tax Cuts and Jobs Act. It was recognized that it was an error. They didn't intend to give it a longer life. Unfortunately, it had to be corrected through law, and the IRS couldn't just say, that Congress messed up and they forgot to include that. It actually had to go back and be a new bill. So they bundled this into the CARES Act to say that qualified improvement property is actually a 15-year property. This is good news because this means it's now bonus eligible, which in the most recent years, bonus depreciation is allowed at 100%. So you'd fully get to deduct any of that qualified improvement property. And the improvement has to be made by the taxpayer, or at least paid for by the taxpayer. Since they recognized this was an error and there was no intent to make a punishment to companies to have a longer life, the IRS did issue some guidance to say if you had qualified improvement property additions in 18 or 19, then you could either go back and amend those returns to show that qualified improvement property is bonus eligible or with a 15-year life, or you can just true it all up in your most recently filed return, whether that was the 19 return or your upcoming 2020 return, to sort of catch it up. So any depreciation you missed because of that longer life, you could now catch it up in your most currently filed return.
Thank you, Brandy.
And with that, I'll turn it back over to Bobby.
Thanks, Brandy. So now it's going to be time for our first polling question. So the question is, do you expect 2021 to be, which of the following? The best year ever, 2020 on repeat, what year is it, or not applicable, or Johnson Lambert employee? Make sure you push the submit button after you select your answer. As a reminder, answers submitted through the Q&A section do not count towards your CPE or CRE credits. Again, the question is, do you expect 2021 to be which of the following? We'll give everyone another couple seconds to answer the question. Okay, I'm going to close the poll. Okay, so definitely a little bit across the board, but the majority has spoken, 2020 on repeat. So now we're going to move on to our next hot topic, COVID-19, specifically the limited time interpretations due to COVID-19. Warren, There certainly has been a lot of activity and changes on this front. Can you take us through each of these interpretations as well as additional risks and uncertainties with regard to COVID-19?
Well, Bobby, there's certainly been a lot happening at the NAIC on the accounting side this year. The NAIC has been hard at work keeping up with the changing environment and various challenges and opportunities that presented themselves to insurance companies. To give you some perspective, the SAP working group typically meets about 3 to 4 times per year. And this year alone, in 2020, there were at least 9 virtual calls or e-votes related to accounting adoptions, many of them focusing on these limited time interpretations that we are covering now. These first few interpretations have already expired, but I do want to review them briefly with you. The first interpretation extended the admissibility period for premiums receivable, high deductibles receivable, and uninsured plan receivables that were impacted by the pandemic declaration. The second interpretation deferred the impairment assessment for mortgage loans and bank loans if modifications to those agreements occur as a result of COVID-19. And the third interpretation simplified the collectibility assessment for accrued interest on mortgage loans and bank loans impacted by loan modifications after the pandemic declaration. These interpretations were effective for the first 3 quarters of the year and are not available for year-end reporting. I've received several questions on the premium receivable item, and those amounts over 90 days past due should be non-admitted for year-end reporting. We do not expect the NAIC to revisit this specific interpretation, but of course, we will keep you posted if they do. On the topic of premiums receivable, the admissibility rules have been extended for premiums due from agents and policyholders that were directly impacted by any of the hurricanes listed here. Also, California wildfires or Iowa straight line windstorms that have occurred since August of 2020. This extension applies to directly impacted policies to defer the non-admission until February 28, 2021. Because of the various starting dates of these natural disasters, this interpretation breaks with prior interpretations that are similar to permit a blanket extension until the end of February. So first quarter filings in 2021 will revert back to the standard 90-day admissibility rule for these impacted policies. The next set of interpretations relate specifically to troubled debt restructurings. The first item requires mortgage loan or bank loan terms that are modified to follow the provisions detailed in the CARES Act and in the interagency statement released by federal financial regulators to assist companies in determining if a loan modification is required to be reported as a TDR. So when looking at a loan modification, 3 requirements must be met for the modification to not be considered a concession or a troubled debt restructuring. And they are: the modification was made in response to COVID-19, the borrower was current on loan payments at the time of modification, and the modification was for 6 months or less. The second interpretation provides additional practical expedience to determine whether a loan modification is insignificant and therefore not a concession or a TDR. Circumstances in which a loan modification is deemed insignificant include modifications that result in a change that is less than a 10% shortfall in the contractual amount due, modifications that result in the extension of the debt maturity by no more than 3 years, and modifications that only impact covenant requirements. These interpretations are effective for the same period as the CARES Act, which was originally through December 31st, 2020. With the enactment of the Consolidated Appropriations Act, Congress extended provisions of the CARES Act to January 1st, 2022. The SAP Working Group has issued an exposure draft to extend both of these interpretations through January 1st, 2022 as well, to be consistent with the extended provisions on which the interpretations are based. The working group is slated to vote on and adopt this extension through 2022 later this month. All of this additional attention on loan modifications brought to light a discrepancy between the bonds guidance in SSAP number 26R and the loan modification guidance in other SSAPs. We're talking specifically for non-troubled debt situations right now. So a clarification was made to bond guidance that after a modification of original loan terms, future other than temporary impairment assessments should be based on the modified contract terms, not the original contract terms, and follow the applicable loan modification guidance. So there wasn't a change to any accounting guidance here. It was just to clarify an inconsistent sentence in the bond guidance. So the term asset-backed securities loan facility was reestablished by the Federal Reserve to support the flow of credit to consumers and businesses. So these are loans available to certain businesses. Many insurers are not impacted by the federal TALF program. However, this interpretation provides accounting guidance for both direct reporting entity borrowers and reporting entities who are invested in an organization that is a program borrower. The interpretation is effective for the duration of the TALF program. So during the pandemic, insurers saw an opportunity to give back to their policyholders, particularly auto insurance companies and medical professional liability insurance companies. This was done as either a discretionary refund, a rate reduction on current or on renewal policies, or through policyholder dividends. This interpretation was developed to document accounting and disclosure requirements for each of these scenarios. If a discretionary payment to a policyholder was made as a result of COVID-19 reductions in activity, then the company should disclose the accounting policy used and the amount of refunds listed by type. The interpretation also introduced a limited time exception for reporting entities to record a premium refund as an other underwriting expense when certain requirements are met. Additional disclosures are required with this selection. We have included an article outlining the reporting and disclosure requirements for premium refunds, including the limited time exception requirements in our webinar resource center today. This interpretation expires January 1st, 2021. All of this discussion around accounting for refunds made it clear that there is variation in how premium refunds not required under policy terms are reported. So a new agenda item has been introduced by the SAP Working Group to address premium refund accounting and the standard statutory guidance. So there will be more to come on premium refunds in 2021. So from an audit perspective, there are a couple of things that may be on your auditor's radar for 2020. Risk and uncertainties may still exist for most organizations, and operational and financial performance depends on the duration and the spread of COVID-19. Your auditor will want to review the impact of COVID-19 on the company and its stakeholders, and in particular on internal controls. Some companies may find that this is a significant risk area for their 2020 audit. Or if your organization receives a PPP loan, depending on the size, that may be a more significant audit area this year as well. With the macroeconomic trends related to unemployment, collectability of premium and other receivables is something reporting entities should focus on for year end. For example, receivables may need to be reviewed for non-admission and for an allowance for impairment losses if those amounts are deemed uncollectible. Depending on if borrowers are current on mortgage loans or real estate payments, reporting entities may be required to consider impairments to those assets or consider obtaining a new property appraisal to support reported values. Also consider impairment related to goodwill or other intangible assets. These assets are typically not admitted under statutory accounting. However, organizations that report on both a statutory and a GAAP basis may be more impacted here. And finally, regarding deferred taxes, income projections using the deferred tax asset admissibility calculations may require additional support this year. Using previous net income to support future income projections may not be sufficient since 2020 results could be an anomaly.
Thank you, Lauren. These interpretations will certainly keep us busy for 2021. So now it's time for another polling question. The question is, what area do you have more concerns about for year-end reporting? Answers are valuation of premium receivable, valuation of mortgage loans, real estate, valuation of deferred tax asset, no concerns, or not applicable, or Johnson Lambert employee. Remember to push the submit button after you select your answer. And again, the question is, what area do you have more concerns about for year-end reporting? We'll give everyone a couple more seconds. Okay, going to close the poll now. Okay, so Lauren, does this line up with your expectations for the responses?
Well, I am happy to see that some of you have no concerns about your year-end financial reporting. It has been a tough year in particular. As I expected, premiums receivable and definitely deferred tax assets are two of the larger areas that will be a focus for insurance companies as you're closing the books this year.
Cool, thanks, Lauren. So now that we've discussed the tax impact, as well as the various interpretations due to COVID-19, let's begin to discuss the new and amended statutory accounting requirements. Rachel, one of the most talked about changes this past year was in regards to the reference rate reform. Can you provide some clarifications on the requirements and the treatments of this reform?
Yes. The industry has been very aware of this transition away from referencing the LIBOR and other interbank offered rates for a while now, but per usual, a few issues came up in the transition process. Outside of the logistical and legal challenges due to the sheer number of contracts that will require modification, challenges were presented since contract modifications typically require an evaluation to determine whether the modifications resulted in the establishment of a new contract or the continuation of an existing contract. Typically, a change to the critical terms, such as the reference rate modification, would require a remeasurement of the contract, or in the case of a hedging relationship, a designation of the transaction. The overall guidance here is that the qualifying modification should not be considered an event that requires contract remeasurement at the modification date or reassessment of a previous accounting determination. The guidance provided by the amendments are applicable for all entities. However, they are only effective through December 31st, 2022, as these amendments are intended to provide relief during the transition related to the rate change. With this transition also came the question of reporting and valuation for basis swaps. For reporting, basis swaps shall be classified as a derivative used for hedging. By using the used for hedging classification instead of an other derivative classification, the basis swap derivative received will be an admitted asset. Although the instrument shall be considered a hedging derivative, the instrument shall not be considered or reported as an effective hedging derivative unless it actually meets the qualifications. If the basis swap is not an effective hedge, the derivative shall be accounted for at fair value, and the changes in fair value shall be recorded as unrealized gains or losses. Now on to some cash equivalents and short-term investment adoptions. Cash pooling is a technique utilized by some companies under common control by which several entities' cash accounts are aggregated to allow better liquidity management, optimization of interest or investment returns, and reduced investment or banking transaction fees. Only cash pools that have obtained state regulator approval and meet the requirements are in scope of this statement. This revision allows specific structures that hold strictly cash equivalents, and short-term investments to be captured under SAP 2R. The accounting for these investments should now reflect the accounting which would have taken place had the assets been held directly and not held in the liquidity pool. Entities reclassifying pools to cash equivalents from a different investment schedule may elect to reclassify effective January 1st, 2021, with early adoption permitted. It's also important to note that a reporting entity must disclose their share of the cash pool by asset type on Schedule E, Part 2. This revision was made to consider guidance for short-term investment structures that are being purposefully designed to mature at or around 364 days, often with affiliates, with the full expectation that the investment structure would be renewed continuously for subsequent years. The original proposed revisions would have restricted the classification as a cash equivalent or short-term investment for all affiliated bonds, loan-backed and structured securities, and investments that would have been reported on Schedule BA as another invested asset in the event that the reporting entity doesn't reasonably expect that the investment will actually mature within the time frame permitted for cash equivalent treatment. Adopted revisions from this update prevents the investments being continually classified as cash equivalents or short-term investments and discontinues the rolling of these investments after initial acquisition. The revisions state that these rolling investments shall be reported as long-term investments under the noted criteria, regardless of the maturity date, unless the reporting entity re-underwrites the investment, maintains appropriate re-underwriting documentation, and each participating party has the ability to independently review the terms and can terminate the transaction prior to renewal. Further, an additional disclosure has been required to identify cash equivalents and short-term investments via designated code, which remain on the short-term schedule for more than 1 year. There were a handful of various investment accounting and reporting changes that were made for the 2020 reporting period that I'll go over next in these slides. First, this non-substantive change adds clarification of whether SAP 43R investments should qualify as bonds for Schedule D reporting. The adoption created a new designation category that will be utilized when reporting mortgage-backed security investments on Schedule D, regardless if the investment is under the Scope 26 or SAP 43R. The current financial modeling process remains unaffected. However, the NAIC designations as produced by the financial model will now be mapped to a final NAIC designation category, and reporting entities will use the new NAIC designation category for accounting and reporting purposes. As an example, the prior modeled NAIC 1 with risk of loss will be mapped to a NAIC 1B, and a NAIC 2 may be mapped to a NAIC 2B. On the website, there's a helpful tool that will help with the change in designation and modifier. There were inconsistencies in the reporting of non-conforming credit tenant loans currently reported on Schedule D, which created some reporting exceptions for the year-end 2020. Due to subsequent questions, this interpretation has been issued to detail the provisions provided and clarify the reporting of non-conforming credit tenant loans in the 2020 financial statements. The consensus was made to provide a limited time exception allowing non-conforming credit tenant loans to continue to be reported on Schedule D, provided that they have filed with the SBO for a designation by February 15, 2021. The exception granted in this interpretation is applicable for 2020 year-end financial statements and through October 1st, 2021. With this provision, non-conforming credit tenant loans reported on Schedule D that have not received an SBO-assigned designation shall be disclosed in Note 1 as if a permitted practice. After this, they should be reported on Schedule BA. If the credit tenant loan was already being reported on Schedule B or BA, it should remain there for the 2020 reporting period. There was also a few changes to the reporting schedule, investment schedules. The first adoption was a non-substantive change to discontinue the use of the NAIC bond fund list. Items which were on this list would be eligible for consideration for the NAIC fixed income SEC registered funds list. The NAIC staff thought the references to the SBO bond fund list often cause confusion, as the listing only includes funds with 100% of their investments in U.S. government securities. The bonds and unaffiliated common stock guidance were updated to reflect this revision. The second schedule change relates to the summary investment schedule. This update was adopted to fix a cross-check error within the annual reporting blanks where mortgage loans reported on the summary investment schedule did not tie to amounts reported on Schedule B. After research, it was found that this is due to the total valuation allowance not being included on the summary investment schedule. So this revision will add an evaluation allowance to ensure that these schedules tie together and hopefully get rid of any cross-check errors. The third schedule change related to the supplemental investment risk interrogatories, line 13, the 10 largest equity investment interests, as there were reporting differences across the industry. This revision clarified that a look-through to the underlying investments in non-diversified equity funds is required for purpose of the interrogatory. Certain SBO-identified funds, investments with fixed income characteristics, and money market mutual funds are excluded from the aggregation of equity interest in this disclosure. This adoption was made to add clarifying edits to the statutory accounting for a participation in mortgage loans. A participation in a mortgage loan is when the reporting entity is not the lender or the named as a payee on the mortgage loan, but the lender of the record sells a portion of the mortgage loan to the reporting entity through an assignment or participation interest under the participation agreement. Questions were raised regarding the scope of the financial rights and obligations that a reporting entity lender should possess versus via a participation agreement, and if these extended beyond the right to receive contractual cash flows. As the participant's relationship is generally with the original lender, they typically cannot sue the borrower, institute foreclosure independent of the other lenders, or under normal circumstances communicate directly with the borrower. These revisions clarify that a participant's financial rights may include the right to take legal action against the borrower, but typically does not include the right to solely initiate the legal action foreclosure or require the ability to communicate directly with the borrower. With the adoption of SAP 32R, all perpetual preferred stock is now to be valued at fair value, not to exceed any currently effective call price. This change in valuation requirement to report these assets at fair value as opposed to historical costs allows for a more accurate representation of the value of such assets, since perpetual preferred stocks are more comparable to equity securities. This is not effective until January 1, 2021, but early adoption is permitted to allow the impact of these substantive revisions to be reflected in the 2020 year-end financial statements. There were a handful of changes to SAP 97 investments in subsidiary controlled and affiliated entities, which I think are helpful, so I'll walk through those now. The first was to update the existing loss tracking reporting requirements for when a reporting entity, such as a parent company, has an investment in an SCA entity with losses that exceeded the carrying value of the investment, or also known as a negative equity value in the SCA investment, and it has provided a financial guarantee or commitment. With these revisions, the reported equity losses of the SCA would not go negative, thus stopping at zero. However, the guaranteed liabilities would be reported to the extent there is a financial guarantee or commitment. This removes the stipulations that would result in the parent recognizing both a liability for any financial commitment or guarantee of the SCA's obligations and a negative value for its investment under the equity method of accounting, which would essentially double count the loss. There was an update later in this guidance to remove some lingering language that guarantees or commitments can result in a negative equity value for the SCA. Next, the NAIC made some clarifying revisions to the existing guidance to emphasize that a look-through is permitted through more than one downstream holding company, as long as each look-through entity complies with the requirements under SAP 97. The last item related to investment in SCAs is a non-substantive revision that will eliminate many of the manual steps required to annually review each submitted SCA. Financial statement filers will be responsible for retrieving their finalized SCA review information from Vision, which will eliminate the need for the entity to wait for the NAIC staff to manually insert the information onto a template to be emailed to the filer. Additionally, various minor updates were made to improve the readability of various paragraphs. There's a very detailed visual instructions available to help understand use of the website for reporting purposes going forward.
Thank you, Rachel. So it is time again for another polling question. The question is, will these changes in investment reporting have an impact on your company? The answers are minimal, some, but not as much as previous years, significant, or not applicable, or Johnson Lambert employee. Again, the question is, will these changes in investment reporting have an impact on your company? Once you select your answer, just please remember to push the submit button. Give everyone a few more seconds. Okay, I'm going to close the poll. Okay, so good majority think minimal. So Rachel, on the GAAP side, there's been a lot of noise on lease accounting and also the delay in the lease standards. Can you explain the updates that were made to be more consistent between stat and GAAP?
Yes, everyone's favorite topics of leases. We've been talking about leases since at least 2016 on this topic. So SAP 22R was substantively revised to make some of the statutory accounting a little more consistent with the GAAP. Issue paper 161 was released in 2020 to incorporate some of the guidance in ASU 2016-02, which significantly revamped accounting for leases. The main difference is the NAIC decided to tweak some wording to be more consistent with GAAP, but left that all leases should remain operating leases. For statutory accounting purposes, if they had adopted all the lease changes that were made for GAAP, the lease asset would be on the statement of admitted assets and would have been non-admitted. So these revisions are effective January 1, 2020 for all new leases entered into, included leverage leases and sales leaseback transactions, and existing leases reassessed due to a change in terms and conditions. So just want to reiterate, SAP 22R prescribes that all leases shall be considered operating leases with rent being expensed. For leasehold improvements, the NAIC staff were notified by a company that the revisions to the definition of lease terms in SAP 22R are not consistent with guidance for the depreciable lives of leasehold improvements in other SAPs, like SAP 19, furniture, fixtures, and equipment, and SAP 73, healthcare delivery assets and healthcare facilities. So as it stands now, lease term in SAP 22R is defined as the non-cancelable period of the lease together with options to extend or terminate the lease if the lessee is reasonably certain to exercise the option. In SAP 19 and 73, the guidance for establishing the life of a leasehold improvement did not allow the renewal option to be included. So this update added the guidance so that 19 and 73 conform to SAP 22R to include the renewable or options period for the depreciable life calculation. Note that leasehold improvements remain non-admitted assets. Since everyone loves additional disclosure so much, the NAIC was like, hold my beer, I got you. This new revision requires additional disclosures for surplus notes, and in particular, ones that are structured to reduce or eliminate typical cash flows, where an issued surplus note and held asset would have been reduced or eliminated. The expanded disclosure requirements are required in the financial statements of the surplus note issuer, or if a reporting entity has ceded business to the surplus note issuer. The revisions would require disclosure of whether cash flows are offset, but would differentiate between administrative offsetting and the contractual linkage that is a concern to regulators, and to provide more useful information about transactions involving surplus notes. The notes on this slide are pulled from the updated SAP 41R with the new revisions and additional disclosures in blue. This is not all of them, so if your company is a surplus note issuer, check out the SAP for more details on what needs to be disclosed now. Last year, we discussed reduced collateral requirements for reciprocal jurisdictions, and this year there was a non-substantive revision to include recoverables from these reinsurers in the 3% unsecured reinsurance recoverable disclosure. As a reminder, the state of domicile has to have adopted the credit for reinsurance model for these countries to be treated as a reciprocal jurisdiction, and not every state has adopted that model to date. Once the state adopts the reciprocal jurisdiction, only prospectively from that date can it go into effect on contracts with states that start after the state adopts it. So if your contract starts January 1st and your state adopts the jurisdiction of your reinsurer March 1st, the collateral requirements are not reduced for that contract. You'll have to wait until next year. So there was a clarification last year with the reinsurance credits for P&C companies, and this year it's a work in progress for life and health companies. Regulators brought to the attention of the working group concerns regarding short-duration health reinsurance contracts, which were term quota share treaties but had features that limited the reinsurer's risk. Concerns were noted that the reinsurance contracts were reported as meeting the risk transfer requirements under statutory accounting, but were not actually meeting those risk transfer requirements under GAAP. In addition, concerns were raised as to whether similar reinsurance contracts that may meet risk transfer requirements for stat accounting were taking a larger reinsurance accounting benefit than appropriate because of the risk-limiting features in the reinsurance contracts were limiting the actual amount of risk transferred. The goal was for the reinsurance disclosures designed to identify contracts with risk-limiting features or non-compliant contracts that are required for SAP 62R disclosure also be required under SAP 61. Disclosures to be included in the annual audit report financial statements and supplemental schedules include provisions that limit the reinsurer's assumption of significant risk. This could be a deductible, a loss ratio corridor, aggregate limit, or some similar effect, the number of applicable contracts, affirmative indication of whether deposit accounting was applied to the contract or if a reinsurance credit was reduced, provisions and a schedule of deferred payments, and identification of GAAP and STAT differences in the treatment. There was also an appendix added which provided a question and answer for treatment of group term life yearly renewable term agreements and clarification to other non-proportional reinsurance agreements.
Thank you, Rachel. So we are at another polling question. The polling question is, my company writes which of the following? P&C lines only, life and accident and health lines only, a mix of all of those, or not applicable, or Johnson Lambert employee? And again, the question is, my company writes which of the following? Again, once you select your answer, please click the submit button. Give everyone a few more seconds. Gonna close the poll now. Okay, so a majority on the P&C lines. So our next topic, this is going to relate to prepayments for unpaid claims, losses, and expenses. We have some clients that prepay, for example, 5% of written premium, where the external TPA will handle cradle to grave. Lauren, how can you account for this?
So this update is a clarification to address inconsistent reporting of prepayments made to TPAs, such as the example you just described, Bobby, where an insurance company is prepaying a percentage of written premiums for a TPA to handle their claims from cradle to grave. This revision clarifies that prepayments to third-party administrators for those unpaid claims, losses, and LAE should generally be reported as a prepaid asset and then non-admitted when certain conditions are met. The revisions came about because some reporting entities were netting these prepayments against the reserve liability. The revision clarifies, and this is not a new change, it is clarifying guidance that has previously existed, that the only time that the reserve liability is reduced is when the claim is paid by the TPA. The revision also clarifies that prepayments to TPAs that do not relate to services or claims adjustments should be reported as an aggregate write-in for miscellaneous underwriting benefits on the relevant annual statement exhibits as noted on this slide. This next update has had a pretty long runway for implementation as it's potentially required changes to billing systems to implement. Interest paid to claimants on accident and health or managed care claims are required to be reported as an other claims adjusting expense. Previously, some insurers were reporting these amounts with interest paid to regulatory authorities, which is on a separate line for regulatory fines and fees. So this clarifies where those amounts of interest payments to claimants should be reported. Another life insurance update, and this one only impacts annual statement reporting. The NAIC has added a footnote to Exhibit 5 for life contracts to separately identify circumstances where mortality risk is no longer present or is no longer a significant factor. So it will be included in the annual statement blanks for 2020, and here is an example of what that disclosure will look like. So previously, the accounting guidance for life contracts did not permit grading in of a change in valuation basis. However, recent changes made to the valuation manual requirements for principal-based reserving for variable annuities does permit the grading in of changes in valuation basis with options including adopting in full during the current year, electing to grade in over 3 years, or electing to grade in those amounts over 7 years, subject to commissioner discretion. The life guidance was updated to permit grading in of a change in valuation basis when described in the valuation manual, as with this example, or permitted by the life contract's SSIP. A change in valuation basis is required to be disclosed in accordance with statutory guidance for accounting changes, and additional disclosures are required to include information about the grade-in period applied and amounts graded in to date, as well as what amounts will be graded in the future. This next update clarifies life, accident and health, and deposit contract guidance that decisions to choose one allowable reserving method over another that require commissioner approval under the valuation manual should be reported as a change in valuation basis. So taking us back to the previous slide, if a life company elected the 7-year grade-in period that is subject to commissioner discretion, this would be reported as a change in valuation basis and subject to the disclosures for accounting changes and the additional grade-in disclosures. Finally, we have a few miscellaneous updates. The related party guidance was updated to clarify that aggregation of similar transactions may be appropriate, even if they are not material on a standalone basis. These transactions will also be data captured for the first time in the 2020 annual statement. For life, health, and separate account guaranteed products, minor revisions were made to recently adopted liquidity disclosure requirements. If applicable, please take note of these. And finally, the scope of installment fees that permit some installment fees to be reported as other income has been narrowed, so make sure you review this clarification if it applies to you.
Thank you, Lauren and Rachel, for that lively discussion. Now on to our last, but certainly not least topic that we will discuss on today's broadcast, the auditing standards update. There have been a suite of new and exciting auditing standards that were supposed to be effective for 2020. However, they've been delayed. Lauren, can you walk us through these standards and also explain to us how we should frame this year's auditor's report, as this will be the last year we see it in this format?
Yes. For the calendar year in reporting entities, 2020 is the last time you will see the audit opinion in the format you are familiar with. So you may want to frame it for posterity. In 2021, the suite of auditing standards will be effective that update the form and content of the auditor's report. This update impacts all audit reports, including statutory, GAAP, other comprehensive bases of accounting, et cetera, including employee benefit plan audit reports. Since these changes to the auditor's report or opinion, as they are referred to, are more significant, we want companies to begin getting familiar with them now before they become effective. So the purpose of these auditing standards updates were two-pronged: to make the auditor's report more informative and also to more closely align the AICPA auditor reporting standards with public company reporting standards, as well as international reporting standards. As I mentioned, this will be a significant change to the layout of the audit report and also includes changes to other parts of the audit process, including engagement letters, representation letters, and board communications. The revision introduces a new option as well to have the auditor report on key audit matters that we will discuss in a little bit more detail shortly. You'll see that this is effective for audit periods ending on or after December 15th, 2021. Originally, this was going to be effective for December 2020 reporting year ends, but it has been delayed due to the impacts from the coronavirus pandemic. So we get another year to adopt this standard. So this is a visual overview of the reorganization of the audit report. The opinion will come first in the report, followed by the basis of opinion paragraph. I do want to point out for statutory reporting entities, if you obtained an unrestricted audit report in the past, there will continue to be the adverse opinion related to GAAP reporting, followed by the clean opinion on the regulatory basis of accounting. So those opinions will look similar. They are just brought up to the top of the page in this new format. Next, key audit matters. If those charged with governance decide to engage the auditor to report on those matters, will follow, followed by management's responsibilities for the financial statements and the auditor's responsibilities for the audit of the financial statements. These last two sections will have expanded discussions of the components of both management's responsibilities and the auditor's responsibilities. Example statutory opinions were just recently released by the AICPA, so we just got our hands on that, and we're working on finalizing a white paper that will show a sample of the statutory opinion for management teams and board members to review. So stay tuned for that, and they will be included as part of, if you're one of our clients, part of our materials that we submit to the audit committees. Since key audit matters is a new reporting concept, I want to spend a moment describing what they would look like for an insurance company. It's similar to the public company concept of critical audit matters, although slightly more broad. Once those charged with governance decide to have the auditor report on CANs, it is the auditor's responsibility to determine which matters are of most significance to the audit for reporting. Examples of key audit matters for an insurance company may include estimates such as loss reserves and adjustable features on reinsurance contracts, significant unusual transactions, or areas with audit adjustments or internal control deficiencies. Significant professional judgment is required on the part of the auditor to determine which audit matters are key audit matters that should be reported on. So as a result, reporting on CANs may vary between entities in the insurance industry, and they could vary from period to period for the same reporting entity. So for example, if a significant merger takes place in one reporting period, that might be considered a key audit matter for that reporting year. Here is a description of the lead-in to a key audit matters paragraph. The remainder of the section would be tailored to each insurance entity and the CANs that were identified. Management should consider several factors when determining whether to ask the auditor to report on CANs. They need to consider the needs of intended users of the financial statements and if those needs are met sufficiently with the current level and types of communication. We are not aware of any insurance regulators requiring CANs reporting to date. However, we will continue to monitor from that perspective and keep you updated. Also consider the value of sharing information communicated in CANs with all parties that have access to the audited financial statements. For instance, CANs could report information that's not already public or disclosed by the company. And finally, consider the cost benefit of additional time required on the part of management and increased audit fees. Remember, those charged with governance may elect CANs reporting this year or anytime in the future. So it is not a now or never decision, and then it can be changed in the future. So just think about that for your 2021 audit reporting period. So there you have the highlights of our new auditor's reporting suite of standards. Bobby, back to you for a few final thoughts.
Thank you, Lauren. So with that, we have reached the end of our webinar. Thank you to our presenters and to you for attending. If you are not receiving our webinar invites and alerts, make sure to subscribe on our website. As Lauren alluded to earlier, on our website under the Resource Center, you will find certain blogs pertaining to today's topics. As always, we are available to you. Please contact us with any questions that you may have. We encourage you to connect with us through social media for the latest updates. Finally, I would like to remind you to download your CPE CRE certificate before you leave this platform. Thank you for joining us. We wish you, your families, and coworkers stay safe and have a very happy and healthy 2021. Thank you.